Good morning. My name is Srinivas. I work on the investment team at Draper Associates. We are an early stage VC firm based in San Mateo. We were founded by Tim Draper. We invest primarily in Fintech. We're one of the first seed firms to invest in cryptocurrency companies and tokens, and we continue to do so. I will be a moderator for this panel, and we have a really interesting mix of panelists. So let me quickly introduce all of them. We have Mike. Mike Kane is the founder of Hydrogen, an API platform for fintech applications. He also founded Hedgeable in 2009, which is an investing platform for millennials. Then we have Scott Robinson. You're the founder and VP of Plug and Play Fintech, where you've helped over 90 fintech startups in the last 3 years, and you partner with massive financial institutions such as BNP Paribas, Credit Suisse, Capital One, amongst others. And finally, we have Rick. Rick Levin is the chair of the Fintech and Regulation practice at Polsinelli. He represents early stage and publicly traded companies. And a couple of decades ago, he started a fintech company himself. So, hi all of you. This will be fun. Before we start, I'd love to get a pulse of the audience. How many of you work for banks, financial institutions? Okay, we have a couple of hands. Trigger warning, I think you'll get a little uncomfortable. And how many of you work for technology companies? Okay, we have a majority. How many of you invest in fintech startups? Okay, good number. And how many of you invest in cryptocurrencies? Okay. So the mandate here is to talk about banking transformation and the role of fintech in it. We'll try to stick to topic. So when I was preparing for this panel, I came across a New York Times article about what fintech means and how fintech has evolved. So fintech basically meant credit cards in the 50s, ATM machines in the 60s, E-trades, I think, in the 80s, and PayPal in the 90s. So Scott, I'm going to put you on the spot here. What would you say was the defining fintech innovation in the first decade of the new millennium? And you're not allowed to say Bitcoin.
Okay, well, that's tough.
Great, I think the mic's on now.
So I think it's very difficult to define an exact moment between 2000 and 2010. We knew there were three kind of major innovations that were moving a lot of this forward. So number one is the influx of PayPal paired with eBay. So the concept there was we had a very significant challenge and friction when it came to digital transactions, particularly online and e-commerce. I think second is folks like wallet. So roughly 2006 to 2009, we saw a movement towards the wallet on the device. And this is also parallel with a lot of the mobile adoption rates that we saw. And I think mobile obviously had a significant impact. So if we think about some of the traditional services when it comes to banking, number one, check balance. So that concept is very important. Number two, send bill or send a payment. And I think three, we saw a great example with USAA with the remote check solution. So that was one of the first major moments that we saw mobile being adopted. So to answer your point, to parallel that with a lot of the capital that's coming into the space, we didn't really see a lot deployed until about 2012, 2013. So over the course of 2013 through 2016, we went from 3 billion to 12 to 16 to 15. And so even this year, we've seen now, again, a return to a pretty significant influx of capital. So to answer your point, I'll go back to Peapod very quickly. If anybody remembers Peapod, the grocery delivery service in the late 90s, it was basically Instacart. And the infrastructure requirement there just simply didn't meet the use case. So the product that wasn't available, you didn't have a backup item, so on and so forth. So this is very similar to what we saw with challenges with banking. If you had a digital challenge on the mobile side, it's very difficult to reconcile that. So there's been a lot of shifts since 2010, but yeah, I think mobile, the access to a wallet, and generally the concept of moving outside of the retail environment is kind of the big shift that we saw.
Fantastic. And in one word, what is the big fintech innovation in the present decade?
Oh, wow.
Yeah, that's really tough. So one word in this decade, I would say trustlessness.
That's a good one. So talking about Instacart in the 90s, Mike founded Hedgeable in 2009, pretty much at the height, I should say depth of the financial crisis. And Hedgeable was sort of Wealthfront before Wealthfront. would you, but you started off your career at Bridgewater, traditional finance, and a few years later you're starting a tech company. So what insight drove you in that direction?
Yeah, so I think as an entrepreneur, and everyone here can probably echo this, it's all about solving problems. So in 2008, the biggest problem was people lost trillions of dollars because there wasn't access to the same things that we were giving to people at Bridgewater for the average retail customer. So we launched this platform called Hedgeable to try to start that, to give people better access to more sophisticated tools. And part of that was, a few years in, we were the first retail platform to invest in Bitcoin. People thought we were crazy, they wrote nasty things about us online, we were stealing things from grandmothers, et cetera, et cetera. Obviously, we turned out to be correct because we believe in innovation, solving problems, giving people access, and really trying to be ahead of the curve. And I think that's really what every entrepreneur in fintech should be looking at. And I feel we haven't necessarily turned the page yet where that's the case, where we still have a lot of more institutional founders in fintech that are really just taking offline businesses, putting them online, or putting some new lipstick on a pig, as they say, and putting some new skin on a platform. So really, the test is going to be the next decade. Can we get some younger, energetic fintech founders to solve problems, to hack and build stuff? And if we do, I think we're going to fundamentally change the ecosystem.
We were talking before the panel, and it turned out Rick was the OG fintech founder in the 90s. Rick, can you tell us about that a little bit? And then comment, of course, on micro-solving problems that for consumers and for retail investors that banks weren't solving using technology. But sticking with the timeline, there's two questions here. One, yes, about your OG fintech venture, and second, around 2008 to 2009, when the regulatory scrutiny was at its highest, how were financial institutions thinking about technology to solve regulatory problems?
Well, one point I would just like to touch on, your first question to my fellow panelists. This is probably the most important creation, not the iPhone, but the smartphone, because I believe this is the bank of the future. I go to community banks around the country and I tell them stop building branches, deploy technology. And we're going to talk a little bit about it. I believe in fintech and financial inclusion. It took me a while to get there, but at a conference in Singapore about a year ago, we were talking about how more people will have access to smartphones over the next 25 years than will have access to a branch bank. And that it will be easier to create commerce, reliable commerce that is protected by the rule of law through smartphone technology, including blockchain technology, than by building a bunch of branch banks. So when I go meet with community bankers, I am Darth Vader. I walk in and tell them to stop building branches, and if I was their advisor or on their board, I would fire a CEO who talks about building new branches. But my background, I started off in 1999, 3 years out of law school. I quit a law firm job to go into a startup company that wanted to be one of the first stock exchanges. This was when E-Trade was advertising with chimpanzees to show people how easy it was to trade stock over the internet. And we famously went to the New York Stock Exchange and said, you should hire my partners and I to build an electronic exchange or to invest in us or just buy us. We were greedy, we wanted the cash. And we said, computerized trading is the future. This was when stocks were traded in fraction and people used to yell at each other on the trading floor. And these guys, room with people serving tea and coffee and white gloves and lots of mahogany and paint flaking, they insulted us. They said we were punk kids, we didn't know what the hell we were talking about. And we said, no, the future is computerized trading, trust us. At a certain point, we were young, but we weren't stupid. One of my colleagues said, you're a battleship. You're big, you're old, you're gray. You can't turn on a dime like us punk kids. The chairman of the exchange became extremely angry. His head turned about 30 shades of purple. He said, did you just call the exchange a battleship? And my friend nodded and said, yes, sir, the exchange is a battleship, and we're going to win this battle. And the entire management of the exchange and the meeting was mortified. And then My younger colleague, who did look like the dorky kid from 16 Candles, said, no, everybody calm down, calm down. They're not a battleship. But someday when this is all done by computer, the New York Stock Exchange trading floor is going to make the best damn discotheque in Manhattan. At that point, profanity flies. Bouncers, aka security guards, walk in, very large guys, and they say, gentlemen, this meeting is over, and we get escorted out and thrown on the corner of Broad and Wall Street. That company eventually sold to Citibank, and then I went into electronic brokerage in New York, most of my career. But we're at a similar inflection point. If we look at today, when I started this 7 years ago, I came back to Colorado to focus on Fintech, and I put Bitcoin and blockchain on there. And somebody at one of the biggest banks in the world, I showed him my business plan as a lawyer, and he said, that thing on the bottom, Bitcoin and blockchain, should be at the top of the list. So I always like to remind people, big banks are not cretins, they're not Luddites, they're not slow to change. They understand. Now, some of them do it better than others. I mean, Goldman Sachs was the first big investment bank who embraces technology. Now they've opened a trading desk. The exchanges are trading Bitcoin futures contracts. So it is a mistake for young entrepreneurs to underestimate the intellect and the willingness to change that is existing in big banks. So when I look at the future here, I would say don't view the big banks as your enemy. View them as people that could invest in you and partner with you and help you grow your business.
So in the 90s, banks were basically getting bouncers to throw out founders. Looks like things have changed a little bit. So Scott, who founded Plug and Play Fintech, you're working with tech startups, helping them grow, and your partners are big banks. Why are they interested in tech startups suddenly? Why are they looking outward for innovation?
So I think I'll just throw some numbers. 1 in 4 investments in financial technology startups comes from the corporate VC arm. So that should be very indicative of what kind of value they see in fintech. There's 3 main problems, and I think to our colleague's point, there's a wide spectrum of strategy in the market and a wide spectrum of maturity of that spectrum in the market. So for example, a South African bank, top 5 bank, some of their C-levels don't understand what API means. And so that, as contrasted to somebody like Development Bank of Singapore, which is now enabling remote onboarding in places like Indonesia and elsewhere, there's a very stark contrast in the market. And if you think about some of the trends that we're watching, particularly on the retail side, so large banks like HSBC, RBS, others, are consolidating their retail footprint and selling it off regionally. So getting back to why do the banks see the value in the fintechs? Well, number 1, they're dynamic and agile. So this is a very important question that's asked, is, hey, can we build this in-house, or does it make sense to build across the street? And so often we see what I would call a Frankenstein bank, an amalgamation of many different small startup services being rolled up into one brand and then offered like a Banco Original in Brazil, or other challenger banks like an investment we made in N26 out of Europe. So I think number 1 is just the dynamic and ability for a startup to move quickly. 2 is the talent challenge. So if you think about tier 1 artificial intelligence or comp sci folks coming out of Stanford or U of I, they're thinking, where's the largest data set that I can find to have material impact on this world? And so that's going to be found in Facebook, Apple, Google, elsewhere. So there's a big gap there. So number 1, I think the challenge that they see is we don't have that type of talent in-house, we got to go get that. And that is often represented by fintechs. And the third point, I think just generally, is the actual image and brand of banks. So if you look at some of the respective trust surveys we've seen in the past few years, year over year, between 2017 and 2018, we've seen the largest drop in trust in any financial service brand. And that's at a global basis. So to that end, the concept, particularly to the millennial demographic, is, well, we need to have a better trustworthy brand, we need to be dynamic and offer them a competitive service that's relevant and very easy to use on their terms. And we need to be transparent about what these costs and relevant value propositions will look like. So there's a lot of value to working with fintechs from a corporate perspective.
Mike is a case in point. You went through Plug and Play for hydrogen, for Hedgeable, and then now you built a fintech startup, and now you're building a platform to help others build fintech startups. So why is that such a pressing need, and who are your customers and how are you serving them?
Yeah, it's an interesting question. So we view banks, insurance companies, tech companies, governments, whoever else, as developers in the end. So we don't really care who the brand is, if it's Wells Fargo or Wells Fargo Limited, some new startup that's launching somewhere in Europe. We view them all as developers, and really the core pressing need is there really isn't core technology infrastructure to launch, deploy fintech applications. So I'll give you an example. When we launched Hedgeable, none of this stuff that we're talking about now existed. There were no APIs, there was no VCs who cared. You had to pay $200 to pitch in New York to New York Angels, or one of these other angel firms, and buy them lunch while they listen to you pitch up there for a few minutes.
This is why you have to move to the valley.
Yeah.
Go on.
Silicon Valley wasn't much different. So, there just wasn't a lot of infrastructure. So we had to make up a lot of the infrastructure. So now you have the opposite problem. There's too many disparate systems, APIs, core banking, brokerage, custody, mid-office, back-office, front office. There's all these blockchain companies, service companies, IBM, et cetera. So there's really not one platform that ties it all together. So that's really what we're trying to do, is provide a core platform. We think we'll get over 1 billion end customers in the next few years, and we're already off to a good start. To answer the second part of your question, we're indifferent to who our end customers are. So we have a lot of corporate customers. Again, we view them as developers, and we have a lot of startups. We're global. We offer our platform now in over 50 countries around the world. So not just US, Southeast Asia, Latin America, Europe, etc.
And you also help these corporate and enterprise customers use the blockchain.
That's right. So we have our own blockchain called Hydro. And what we do, we feel is very disruptive, because instead of hiring IBM or one of these other companies, which are essentially consulting relationships, we allow you to deploy smart contracts with just an API call. So we have a totally decentralized ecosystem. You could take your current infrastructure, and that could be hooked into a core banking application. Let's say you wanted to build a savings app. You just hit our API, and you could actually launch these smart applications within your infrastructure. And that could take 2 minutes to do. So we're not, they're paying us for consulting, they're just hitting our API. We'll actually have an application in the App Store, which we're excited about. It's a 2FA app that would compete with text message or SMS or Google Authenticator. And that would be a way for you to use these kind of applications out of the box, and we'll keep doing that going forward.
It's funny, I mean, I feel like we're living in, to quote the Lord of the Rings, one ring to bind them all, or one blockchain to bind them all. Everybody's trying to build the best blockchain. Everybody's trying to say that their technology is going to be the best, whether it's Corda, from R3, it's Hyperledger, it's you folks, it's Ripple, it's Stellar. I get to sit back like the lawyer and say, well, this is great fun, I'm blockchain agnostic. And I think that I like to remind people that I work with I'm not a technologist, but I'm the son of a technologist. I grew up programming computers. My father was a professor. And I laugh because each blockchain has pros and cons. And when I look at entrepreneurs, I'm saying, okay, which blockchain is the best for your business? Which one is maybe the most cost effective for your business? Going to IBM or R3, great. You go to IBM, IBM's got a great brand, but the old joke on Wall Street was you don't get fired for hiring IBM or PwC. You also pay through the nose. So depending on what type of company you are, you may end up going to a different blockchain provider and saying, this is a better fit for us, it's more economical, and that's who we should work with.
It kind of blows my mind to see IBM selling blockchain solutions to banks. I told some of you this, but my first job was at JP Morgan, where I worked with mainframes, also supplied by IBM. On one hand, IBM continues to give banks the same technology that helps them be very sturdy, centralized services, and on the other hand, also serves them with technology that will help them in some way work with decentralized applications. So it's quite interesting. They cornered both ends of the market. When Scott described banks as agile, I had to laugh a little bit, because having worked for a bank, that's not what it felt like.
No, I was describing startups as agile, not banks.
Oh, got it.
Big difference.
Big
Yes.
difference, okay. Thanks for
No,
clarifying.
in fairness, okay, if you think about the battleship, and I laugh, how many people in this room saw that movie, Hidden Figures, about the women that did the computations? They were called the computers. I laugh because we as human beings are walking around with metaphorical dinosaurs every day. The internet is a dinosaur. The computers behind the internet, in many respects, are dinosaurs. It's a wonderful GUI that we all play with on our computers and on our phones, but in many respects, the computers used by big banks and insurance companies and governments and aviation companies and automotive companies are dinosaurs. Some of them are still running on Fortran, technology from the movie Hidden Figures. So the problem is these are corporations that have shareholders to answer to. And entrepreneurs walk in and say, we've got the best idea in the world. And the bank has to say, yes, we love your idea, but we can't go to our shareholders and say that we're dropping $3 billion to tear all of our mainframe computers out and to replace it. So it is a bit of an evolutionary process that's going to take time. And I know that's frustrating for many crypto entrepreneurs who think we've got the best idea, we can do it tomorrow, but the banks push back on that.
I know we're supposed to be talking about banking transformation, but I think we spent 20 minutes being extremely polite. Now we can go rogue. It's always funny when banks use the blockchain or talk about crypto, because in 2009, I think when the very roots of Bitcoin was in as sort of an opposing force to these large centralized financial institutions which had outsized control on the economy. Come to 2018, banks are talking about using the blockchain, which is again the core of Bitcoin, to continue to do what they're doing. Does that even make sense? Does the blockchain really aid banks, or is it a threat? And we'll start with Rick. And I want all of you to comment.
Well, okay, I'm going to be the contrarian on the panel.
No politics.
When everybody blames the big banks, and look, I represent big banks, and I've represented them throughout my career, and I represent entrepreneurs. When people blame the big banks for the financial crisis, I say that's a fairly pedestrian answer. The fact of the matter is, all American citizens took out more debt, took out what used to be called a second mortgage. It was rebranded a home equity loan. They bought extra boats and cars and flat panel TVs and Ferraris. You had people buying homes that were 10 times their income. They were buying second homes 10 times their income. And the Fed kept interest rates at virtually zero. Now, banks are like crack addicts. If you give them free money, they're going to take free money. And if you give them a pool of garbage loans, they're going to package those loans and resell those to manage the risk. So at an event I was at, there was one of the members of the Federal Reserve Board, and she was talking about how the Fed's job is to take away the punch bowl when the party gets out of control. And I raised my hand and I said, I'm sorry, I don't think you took away the punch bowl, I think you spiked the punch bowl. And she laughed, and everybody was mortified, and then she laughed and she said, well, the chairman of or one of the presidents of one of the Federal Reserve Bank, I think it was Richmond, said the exact same thing. Blaming banks is not the problem. Working with the banks, the fact of the matter is there are people in the crypto community who say they're going to blow up central banks and they're going to destroy custodians and clearinghouses and exchanges, and that blockchain's going to do everything. And I think they're pie in the sky dreaming. Custodian banks, exchanges, clearinghouses all serve a purpose. They curate, they manage data, they manage information, they try to mitigate risk. Now, can blockchain and other technology work with them to maybe replace some of these old legacy systems? Yes. But I think it is a bit of pie in the sky dreaming to think you're going to replace the entire financial infrastructure of the world just by deploying blockchain.
I know all of you were set up very early. We were all early adopters of crypto and Bitcoin. Mike, do you want to comment? Do you want to counter, support?
Yeah. So, obviously you probably know my opinion on private blockchains. I feel it's an oxymoron. Those are just glorified database companies that are starting in 2018. There's nothing wrong with that. If they want to, pitch people $1 billion contracts to redo their database, more power to them. But I don't feel it's a mistake to lump that in with decentralized blockchain technology. So I'll give you an example. We could deploy for any bank, insurance, tech company in the world tomorrow, public blockchain, without them getting all scared and peeing in their pants like they do when they talk to us about all their customer data is this and that and all these stupid excuses they have. A very simple example, most banks now don't ever meet their customers. and especially in Asia, most banks are tech companies. They don't have branches. They have a billion people, maybe Ant Financial at some point, doing transactions and using their apps. They've never met them. So what if you could add, through decentralization, just an authentication layer, that someone would have to use the blockchain to authenticate themselves before they do that transaction at the point of sale or e-commerce basis. So those are the ways that we're thinking about solving problems, where you could use the blockchain and all the cool parts of it, and you don't have to interfere with any banking regulations or banking infrastructure. And I think the more companies that try to think like this, the faster we'll get adoption. And unfortunately, there's just too many people who are now, like I said, were in institutional places, and now they're blockchain experts, and they launch blockchain companies, which are really just consulting firms or database companies, and they're really not solving the core problems that are out there.
Scott, do you want to comment, having worked closely with banks, how are they thinking about the blockchain?
Yeah, well, I think you have to modularize the use case. There's not something that you just blockchain all your problems and there you go. It's not like email is all the communication that we do today. We have paper still being sent left and right. So the point I'm making is that there are really obvious use cases like identity, which cut a very low-hanging fruit element, friction points that are used ubiquitously across banking services, whether it's for lending, from a credit perspective, or all the way through the ability to just onboard a unique individual. And so use cases like the challenge that I work with BNP Paribas, where you have now GDPR and so forth. If you're an individual in France, you have a bank account there, opening one up here in Bank of the West in California is a very cumbersome problem. You're doing the same onboarding process. But if we could reference something that binarily says the information is exactly the same without passing information over, that's a very simple use case that makes a lot of sense for the industry. And that sort of points back to, I think, the idea of a public blockchain in that sense. You're not going to be able to trust one market or one sovereign state's perspective on identity, and that makes a lot of sense globally to have something as robust as a public offering that maybe attaches to your local device. Like we've seen a number of companies like Civic or others that are trying to focus on that use case and offering. But I think also to your point that the banks have a pretty significant problem right now, particularly post 2008. Mainframe computers, there's been a significant 9,000 to 4,000 reconciliation of all these different banks that having been absorbed up to the larger banks. And with that comes all their infrastructure. And so a common challenge that we see generally from the C-level perspective is how do I manage all these services? And that's why, again, the challenger function seems to be so attractive is we can clean slate and move over here and build something off the cuff, and then that moves as quickly as we need it to be. And I think blockchain does offer some pretty straightforward value to the banking industry, and I think that's what we're seeing right now. The other area I would say is just this concept of attaching tokens to assets, the provenance of assets as it may relate to the bank perspective. That is a very big subject, it's a very valuable subject, and we've seen fraudulent activity around this subject. So I'll leave it with just one example. We saw a large Chinese coal mine sold 3 different times, so north of a $50 million ticket. And this is a great example where if we had a little more information ubiquitously about that asset across the financial services industry, that could have been avoided. So yeah, I think it's incremental change, but at the same time, there's a whole other trajectory path that's going alongside of parallel, which one way or another is going to impact the financial services industry.
And you have to be careful listening to this discussion. The technology is great. I mean, when I joined my firm, they asked me, okay, you're founding the Fintech practice, and I said, it's going to be the Fintech and regulation practice. And they said, why is that important to you? I said, well, 1, I'm a regulatory lawyer, and 2, I've seen too many people get in trouble not paying attention to the regulatory side. So if you look at when the Dow launched, people called me and said, Rick, what do you think? I said, it's an illegal sale of a security. Hell, Vitalik and Vlad and everybody and Joe Levin, they better call me. Sorry, that's Ether. I'm digressing, but when the guys founded the Dow, I said it was illegal. Now we're hearing stories that people are thinking that Ether is a security. I'm not going to comment on that because I don't want to give an opinion that could cause the price to be affected. But all of these people that are launching tokens have to be very careful. And it's not just the token offerings, it's the digital asset offerings, it's the deployment of technology. Blockchain is great, but if you don't pay attention to like the GDPR, the data privacy regs, you could end up running afoul of laws, and you could end up getting sued, and you could end up getting shut down. So we always try to tell people, don't just think about the technology.
So what are the problems, do you think? Like, is it regulatory, or is it just phobia of anything that's new?
Well, I think banks are very careful. They understand that they're regulated. They understand that they're public. They understand they have a public trust. They also understand that they caught a bunch of hell after the financial crisis and their brands were severely damaged. So now when you talk about them deploying new technology, they're being fairly judicious and careful. But you are seeing firms like Credit Suisse working, I believe, with Symbiont, Mark Smith, my former roommate, and you are seeing people saying, how can we use blockchain in the LIBOR space? How can we use blockchain in securities lending or in the RMBS space, securitization space? There's a lot of experimentation going on that is unrelated to cryptocurrencies and more about using the technology to create new digital assets that have wonderful audit trails that can improve regulation and improve the safety and security of institutions. So I think over the next, I think we're in maybe the second or third inning of the baseball game. This is still very early. It is eerily reminiscent again of the late 90s when the internet was starting to come into banking, electronic brokerage and high frequency trading were just starting. It's still very early.
I think there's two challenges that we see, and you could probably echo this as well. Number one, education. Yes, they might have divisions that do cryptocurrency, but do they understand what they're even supposed to be piloting or looking at? The answer typically is no. And that's a big thing that we have to do as startups, is building more educational materials to onboard and show that this isn't that scary. We could help you to use it very quickly. And number two is centralization. Like I said, banks are brands. Most brands don't want to disperse their power, and that's what a decentralized ecosystem does. So it's really butts heads with their core value proposition to their shareholders. So what we try to do is change the conversation from building applications on top of blockchains to building applications with blockchain. So what I usually do is I whip out our app, I say, look at this app. I don't tell them anything about the blockchain, and I show them, you could get set up, authenticate. We're doing a cryptographically sound technique on your phone. Someone has to hack into your phone. Here's 1,000 reasons why it's better, and it's totally free for you and free for your end user. They say, awesome, I want to use it. If I were to say in that same sentence, well, then use this Ethereum blockchain, they say, oh no, we don't want to use it. So it's really about integrating the technology within real-world use cases. That's going to take us from a early innings kind of technology to a late innings technology, and we're just very far away from that happening.
I was just going to say that's such an important point on the education side. My friend Chris Skinner threw a slide out a couple months ago. 94% of C-level executives in the United States in financial services do not have a technical background. So that implicitly means somebody's telling them what this technology is. And then when you look at some of the surveys with these same C-levels as it relates to blockchain, there's this impetus to say 60+% say this is going to be influential and impactful to my industry, and 34% say I have some of an understanding of what blockchain is. So that gap, particularly with my experience, I've seen about 1,000 pitches in person relating to blockchain. And walking down that little rabbit hole when we get to that topic, where the counterpart from the corporate side literally has no idea, it completely derails the conversation. So education is a very important element at this point, and we've seen this reflected and adopted by a lot of these folks. We're seeing the role like a chief digital officer or chief startup evangelist. So there is kind of this onboarding function that's now startup specific from, let's say, a lot of the incumbents in the space. So there is progress there. But yes, with the blockchain topic, particularly with all of the change and the swift nature of this market, it's very hard to stay abreast of what is actually happening and the implications for adopting it. So I just can't emphasize enough, to solve a real problem is also a very core challenge. We've seen a lot of startups build with the assumption that if they create like a critical mass in the Bitcoin or blockchain ecosystem, they can reach up and grab and solve the problem thereafter. And I think that is the poor way of going about it. You should be solving the problem, and then if blockchain is an element of that solution, then you can touch on it when it comes to the technical element of diligence. But don't start with blockchaining all your problems.
Style, JP Morgan got bigger and I was there. So in one word, 20 years, will your bank be from Wall Street or from Silicon Valley?
Well, I think it's going to be a combination of the two. I mean, after 20 years of doing this, the first time I started seeing Silicon Valley and Wall Street really talking other than with respect to an IPO was when Lending Club and Prosper launched. And then you started seeing people like John Mack, the former CEO of Morgan Stanley, joining the board of Lending Club. And then you saw Sheila Bair, the former FDIC director, getting into fintech. Duncan Niederauer, the former CEO of the New York Stock Exchange, the father of pretty much electronic trading at Goldman Sachs, get into the space. You know, the first investment he made was in a fintech company when he retired. So I think it's not one or the other, it's a combination of the two.
Scott, you work with startups and banks and you're not allowed to be diplomatic. 20 years, Wall Street to Silicon Valley.
Well, let me preface with what's happened in media, because I think that's a really interesting parallel. We've seen a very significant shift in the business model there. And the tea leaves in the financial services market are actually out there right now. We've seen negative interest bonds. We've seen bonds move very differently than they have historically. The revenue that we've seen traditionally from fees and fee structures for a lot of the retail business is dropping significantly. And this is not only for the influx of fintechs coming after that business, but also the channel for which the relationship is actually going to the consumer. So the point I'm making is the business is shifting very quickly, and those that are best positioned are those with the most information. So this is device level entities like Google or folks like Alibaba or others that are working on Alipay. The concept of chat compared with device level information at an overarching understanding of your use of the respective services creates this really powerful, moated understanding of your user. And the problem that banks are going to foresee is that we've seen success, folks like TD up in Canada, our number one financial services app that we've seen there. But those that don't adopt this understanding, this sense of urgency that, yes, Google's going after remittance solutions, Facebook as well. There's going to be banks that come from every other walk of life attacking what the traditional offering would look like. And again, when we get to this millennial demographic, it's very clear they don't care which parents went where for what service. They want the best that's most transparent. So that void offers quite a bit of opportunity for those that can solve that problem better. So yes, there will be banks in 20 years, but their business model will be very different.
Will your bank be from Wall Street or Silicon Valley in 20 years?
I actually think it will be from China, to answer that.
Mike, would it be the same question for you? In 20 years, would the most impactful banks be your banking customers or your customers who are using your platform to build their own financial services?
So it's an interesting question. I do feel it's regional in terms of banks versus technology companies, because in many markets we deal with a lot of banks. Let's face it, the banks are the government. That's who we're dealing with. They're propped up by the government. They will never fail. The government won't let competition come in. They're very anti-competitive landscapes, and that's just the way it is. So it'll be very hard to say 20 years from now that they won't exist. In other markets, you have 2 billion unbanked or underbanked people in the world. They don't know any of these banks. They could care less. They've never had a bank account, so they don't care if it comes from a tech company or a bank. So we view it more like a product play. You need to put out the best product possible and get users to believe in the products that they're solving problems that you have. And I don't think they're going to care like my parents care that it's Wells Fargo or some startup. Can they get it to them cheaper, faster, more transparently? That's going to be the banks of the future. Obviously, we think we can help to expedite that process. Especially we deal a lot in Southeast Asia, Latin America, some places where no one can't even name you a bank. They might not even know what that means. They know that they want to pay for something, transfer money to their friend, or they want to maybe invest in this new thing called Bitcoin, and they don't really have a platform to do that. So that's really, we feel, the problem that needs to be solved first.
Yeah, but I'm going to say this. When Bill Gates looked at Bitcoin 5-6 years ago on Fox News, he said, it's a techno tour de force, but governments want to regulate currency. And I politely disagree with my colleague saying it's China. Ant Financial tried to buy MoneyGram, they got blocked. A group of Chinese investors tried to buy an exchange, a stock exchange that has virtually no volume, the old Chicago Stock Exchange. They got blocked by anti-China bigotry. So I don't think we're going to see a world where banks and American deposits will be held in Chinese institutions without a fair amount of, I would say, consternation and problems in Congress.
That's a fair point. I think I was actually hinting that a lot of the Chinese are the miners behind the Bitcoin network, so that's where I was going with that one.
To Mike's point, I think that even if a technology-first company ends up providing banking services, they will still be regulated. But that said, I think the larger question is, can banks really leverage technology retroactively, or would a technology-first company have to offer end up offering the best financial services? So I'd love to get the pulse of those around us. 20 years, which of you do you think that your bank will be a traditional banking company? Show of hands. A technology company? All right, we have consensus. On that note, I think this has been a wonderful discussion. Thank you so much. I don't know if you have time for questions, but if anyone's got questions, we'd be happy to take them. Go ahead.
So the fourth statement on the Bitcoin Genesis call was something about the Bank of England, right? Critical of the Bank of England. Obviously, Bitcoin, Satoshi Nakamoto didn't like banks, and Bitcoin doesn't like banks. So do you think Bitcoin is inherently incompatible with banks?
Well, first off, we don't know who Satoshi is. I am not Satoshi, but I've always suspected there were 5 or 6 people that got together to create the protocol, and one of them may have been a lawyer. And I don't think that Bitcoin hates banks or is antithetical to banks, and I don't think banks hate Bitcoin. If you look at the futures exchanges that have launched Bitcoin futures contracts, they would not have done that if their customers didn't want the ability to hedge Bitcoin risk. And their customers are trading firms, investment banks, high frequency firms, and hedge funds. So I don't think that it is this battle between, and I think that's a mischaracterization when people say, oh, Bitcoin and blockchain are going to destroy the banks. I don't think that's it at all. I think that when they created those futures contracts, that actually added a level of a seal of institutionalization and recognition of the value of Bitcoin and other digital assets. So I don't think it's any type of opposition between the two.
Well, and let's go a little bit further. Who here uses Coinbase to buy their Bitcoin? Okay, well they've got about 20 banks invested in them. So they got off the ground likely from a large seed round to get that channel to buy that Bitcoin. I'm not saying that's the right way to go about it, but clearly the banking industry represents a channel to the consumer that is helpful for bringing traction and engagement to the Bitcoin industry. And some of the rails are simply unavailable in certain markets outside of the bank. So we did see in the very early days things like local Bitcoins and others to be very, very powerful and important in the building out of reach for the Bitcoin ecosystem. But I would get back to the point more or less, again, back to media. We all heard the news that there was some sort of earthquake and a volcano erupting in Hawaii right now, and that's free information that we have. But if I wanted to get really in-depth information about that, maybe I have to pay for a specific research study from the USGS. And perhaps that's the corollary of the business model, wherein the bank may have to provide some new value on top of the Bitcoin network, and maybe there's an opportunity for collaboration there. So maybe they move more into consulting or an analyst perspective, and this is the perfect algorithm for your savings function or something like that. So I think there's a lot of relationships there, but yes, I remember going to the Bitcoin meetup in Silicon Valley at Blue Ocean Sushi with Roger and all the core developers, and yeah, we were all scraggly bearded talking about how we're going to overthrow the central governments and build a peer-to-peer financial solution for this world, and it became very clear there's a lot of steps to get to that point. A lot of people don't want to see that happen.
I want to quickly counter your point about banks investing in Coinbase. The same banks also went and blocked their customers from doing any cryptocurrency transactions. They invest because they want the upside, but why would they block?
Well, I guess it depends which market. So Mitsubishi, the largest bank in Japan, invested in Coinbase, and if you look at where the highest engagement and value relating to Bitcoin transactions, Japan is one of the largest markets. So it really depends which market and how that's relevant to the actual regulation paradigm opposed to it. So we also saw the same thing with payment processors, Visa, MasterCard blocking elsewhere. So yes, it's really dependent on market as well as the disposition of that market as it relates to the regulation paradigm.